I will begin our today's video with a quote from the book of a renowned economist and author, Mr. Adam Smith. In his book, The Wealth of a Nation, 1776, I quote, "It is not out of the benevolence of a butcher or a baker that we get our dinner, but it is out of the regard of their personal interest." Of late, we have been treated to a lot of information that money market funds are not an investment, while those pushing that kind of information, they end up defining a money market fund as an investment vehicle. But what is the right position of a money market fund? And in our today's video, we are saying ignore that information that says a money market fund is not an investment and adopt the thinking of a portfolio in your investment. To define a portfolio in financial terms or under personal finance, a portfolio is a basket of your collective investments. It's a basket that contains your shares, your bonds, and other interest-bearing instruments that form the overall investment. This basket can also contain collective investment schemes where you have invested, and one such will be a money market fund. It can be a fixed income fund. It can also be a balanced fund or an equity fund. And therefore, in totality of that view, then, when you are planning your investment or in investing, there are two key things. One is a goal, the purpose for which you're putting aside and investing your cash. And the other important element is your risk attitude or your attitude, appetite towards risk. Those two guide us in formulating investment portfolios. Why do I insist that we change our thought about a money market fund from just a money market fund to a portfolio? It's because when we are talking about investments, at the end of the day, what you are building a portfolio looking at 5 important elements. The first one is liquidity. The second one is diversification. The third one is growth of capital, and the fourth one is income distribution. A money market fund is simply a type of a mutual fund that we use as a cash management and investment tool or vehicle. It is one of the many ways through which we get ourselves into the capital marketplace. The simplest definition of capital is the resources or the money that you need to start, grow, expand your business. And therefore, in investing, we, the savers, who are the investors, we give our saved money, which now is capital, to users of that capital or persons, parties that require that money for purposes of expansion of their businesses or growth of their business, their working capitals, but rarely for startups. You can go to the capital marketplace either directly as an individual, that is when we talk of a DIY investor, or you can go to the capital marketplace through a market intermediary. In our case, that is when we get the fund managers. The simplest way and easy way to look at a fund manager, see a fund manager as a financial market aggregator, a person who puts money in a basket from different individuals, many people, then takes that basket on the behalf of those many people and delivers us to the marketplace for purposes of investment. This intermediary, the financial aggregator, the fund manager, will use different baskets, which we are now calling tools, options, or investment vehicle. The first basket, we call it a money market fund. The second basket, you call it a fixed income fund. The third basket, we call it a balanced fund. The fourth basket, we call it an equity fund. Those four, they form what we call the traditional collective investment schemes. They are tailored and utilized for the local market. We have new, contemporary, or alternative baskets that are now in the market that expose us not just to the local market where these traditional four baskets expose us to, but also to the global market. And that is when we talk of special funds. And therefore, it is improper to say that a money market fund is not an investment. This is a tool, a vehicle like any other that one can use an investor to achieve their goal in investing. The capital that we gave at the capital marketplace will either be used for a short investment period, a period of not more than 1 year, and it gets paid back to us, or that capital will be used for a period that is more than that period, that is more than a year, and that is when we talk of a long-term investment. The users of capital, they will issue documents such as bond papers, that is treasury bonds for government, corporate bonds for companies. To distinguish or to split or to divide what we are calling bond papers, depending on the period of investment. For short-term investment, that's when we talk of commercial papers for companies and treasury bills for government. There are other instruments or types of paper that will be used for borrowing or debt capital. And the other instance is where now we issue shares or stocks, where if you invest in such, you are not only investing for a return in the name of a dividend, but you are also owning a part of that business. When you take the thought of your investment as portfolio building, then liquidity becomes a very important element in your portfolio. What is liquidity? A good student in finance and accounting and a classification of assets. We have a base that we call permanency, where we talk of current and non-current assets or fixed, non-fixed assets. And we have another base of liquidity. Liquidity is a term that we use to describe the ease or how fast you can convert an asset back to cash. If it is land, how long will it take you? How easy is it to convert, liquidate, sell that land and converting it back to cash? Liquidity is a base that we use to classify our assets into liquid assets and illiquid assets. Current assets, non-current assets. Liquid assets are those investments or assets that are easy to convert to cash. They take us short time to convert them to cash. And this is now when we use the other term, cash and cash equivalents. There are two facts. The capital market's latest report on collective investments indicates that the total assets under management by all the 39 registered and regulated fund managers stands at 4 billion short of half a trillion. That is 496.21 billion. And out of that total, 319.75 billion are invested in money market funds. That is close to 70% of the total of 496.21 billion held under collective investment schemes. It can't be possible that for all those years that the capital markets have been in place, we have always gotten it wrong by using money market funds as good investment vehicles. The second fact to look at is when you look at the asset allocations by your fund manager. This schedule is the asset allocation by CIC asset managers on their money market fund. It is important to note that demand deposits, cash and net settlements take up 25.4% of the entire asset allocation. The next one, this is the asset allocation by CUSA asset managers, and it's notable that collective investment schemes and cash and bank deposits take up a 12% of the total assets allocation. The third schedule, this is the asset allocation by ethical capital's money market fund, and from it, it's clear that 21% of the total assets under management, in this case, have been allocated under cash and the cash equivalent. This is to stress of the importance of liquidity in your portfolio. The argument that money market funds is not an investment is coming at a time when the market returns from these investment vehicles have been declining or coming down. But looking keenly at the peddlers of that information, this is a new crop of wealth coaches and financial literacy entrepreneurs whose objective is to convert investors in money market funds to another product or a promotion of another product. And that is the reason why we started the video with a quote from Adam Smith that it is not out of the benevolence of a baker or a butcher that you get your dinner, but it is out of their personal regard for their own interest. If we look at the performance of Saiton's money market fund, and the reason I'm picking Saiton money market fund is that this fund has been topping the list on performance since its inception to date. Looking at its performance in 2021 July, they were returning at 10.8%. Comparing with their current performance in August 2025, their current performance is higher than the performance in July 2021. The next schedule, Titan's performance in 2023, where the money market fund was returning at 12.5%, which again is lower than its current or prevailing return. And therefore, it is to say that even at the moment when we are being told that money market funds are not an investment, they are giving us a return that is way more than what these money market funds have been giving us before. The good way to look at your investment is looking at it as a portfolio, a basket of different investment products, whether through collective investment schemes or through individual asset classes. And that way, the first part of your portfolio that is very important is a portfolio that gives you liquidity, a percentage of your entire investment that gives you liquidity, because we hold cash for three reasons. You need cash so that you are able to take care of emergencies when they happen, so that you don't fall into the trap of debt. The second reason why you need cash or liquidity in your portfolio is so that you are able to take up speculative opportunities when they come up. And the third reason why you need liquidity in your portfolio is for transactional purposes. Three reasons why you need cash or liquidity in your portfolio: for transactional purpose, speculative purpose, and emergency purposes. And that is the reason why a money market fund or any other account or positioning in your portfolio that can replace a money market fund, because it has similar features, giving you easy access, flexibility in your portfolio, it's an important part of your portfolio. The reason why you now need to create other asset classes or other funds in your portfolio is for the reason of growth, because growth comes with long-term investment, and one attribute that must be in your long-term portfolio is stability, where stability is what gives you protection in your investment, And two, stability gives you consistency in the growth of your capital. So as you purpose to invest to grow your capital, there are those segments or parts that must compose your portfolio. And the first part that protects the rest of the portfolio for growth of your capital is liquidity. Liquidity can only be achieved in either a money market fund or a fixed income fund that gives you the same level of access. At the point of investing in a money market fund or a fixed income fund, there is the fact that in building a portfolio, we don't stick to the return, because the purpose of the proportion of the portfolio that we shall hold in a money market fund or in a fixed income fund, it's purposed for liquidity, meaning that the capital can also be accessed when there is a need, especially for an emergency case. And therefore, the return should not be the worry in that segment of investment. The other parts of your portfolio is what must give you a stable return that grows your capital over time, and should also give you some level of certainty or objectivity in your planning to achieving your goals. And therefore, as I conclude, a money market fund can also be used as a standalone tool or vehicle for investment by an investor of a low risk appetite, including for long-term investments. Thank you for watching, and see you in our next video.